Welcome to The Explainer. Today, we are diving into a really powerful professional strategy that's used in funded trading programs. It's called account rotation. And honestly, it's a method for managing risk, psychology, and your capital in a way that can completely change the game for you. Okay, so here's how we're going to break this down. First, we'll talk about the trap that so many traders fall into. Then, we'll introduce the solution, account rotation. After that, we'll see exactly how it works with a really clear example, and then touch on the psychological benefits, which are huge. And finally, we'll look at how the pros scale this whole thing up. All right, first things first, let's talk about a super common but frankly, risky approach, putting all your eggs in one basket, all your focus on a single funded account. I want you to think about this for a second. When your entire performance, your entire funded journey is tied to just one account, doesn't every single trade feel like it carries this immense weight? It's so much pressure. One bad day, maybe a string of losses, and suddenly that fear of blowing the account is it's overwhelming. You know, the dream is always that smooth, steady climb up to that first big payout. But the reality for so many traders, it's a stressful roller coaster. It's these wild equity swings where just one bad drawdown can threaten your entire funded capital, and boom, you're right back at square one. So, what's the alternative here? There has to be a better way, right? Well, let's get into a more structured, more professional approach that treats trading like a real business, not like a trip to the casino. And this is it, account rotation. So instead of going all in on one account, you operate a portfolio of them. Now, the key difference here is that your risk is no longer static. It's dynamically split up and managed across your entire capital base. It's a whole different ballgame. And this right here, this is probably the most crucial point of the whole thing. It's a mindset shift. You're no longer just trying to predict the market's next move. Instead, you are actively managing a system that's designed for long-term survival and, of course, profitability. But how does this actually work in the real world, day to day? Let's walk through a simple, but I think you'll find an incredibly powerful example. Okay, so picture this. You've got 3 fresh 100K accounts ready to go. You start trading the first one, account A, and you take a couple of losses. It goes down 2%. Now, the old you might get stressed, maybe try to revenge trade to win it back, but not anymore. You simply pause trading on that account, and you move to the next one, account B. And on that fresh account, you have a couple of nice wins, putting it up 2%. Now look at this. This is where the magic happens. What's so fascinating here is that your overall trading performance is completely break even. You're flat. But, and this is the key, because that 2% profit is isolated in account B, you've actually generated a $2,000 payout. This just brilliantly shows the power of the system. You can literally get paid even when you're not on some massive winning streak. Beyond the numbers, maybe the single biggest benefit of this whole strategy is the psychological stability it gives you. It's a game changer for your mindset. This quote just nails the feeling it creates. You're no longer desperately trying to save one wobbling, failing account. You're just calmly managing a portfolio. You always know that you have a fresh, healthy account ready to trade. The goal is to always have a funded account available, and that just removes all that do-or-die pressure. And I mean, you can literally see the difference when you look at the equity curves. A single account's equity can be just chaotic and super stressful to watch. But a rotated portfolio, it just smooths everything out. And this protects not only your capital from a catastrophic loss, but just as importantly, it protects your mental state from making bad, emotional decisions. Okay, so now we get the mechanics and the psychology behind it. So let's see how this builds from just a simple strategy into a much larger professional trading operation. So if you talk to the professional traders who use this method, many of them will say that a total funding amount of around 600K is a real sweet spot. It's highly effective and still manageable. This might be split across, say, 3 maxed out accounts from different firms, which gives you a really solid capital base to rotate between. Now, here's a really important detail. The type of prop firm you use, it matters a lot. Whether they trade CFDs, that's contracts for difference, or futures, dramatically impacts how you can apply this strategy, especially when it comes to your risk and how big you can trade. And here's the professional secret, right? On the CFD side, firms have very strict daily loss limits, often around 5%. So on a 100K account, your real risk buffer is only $5,000 in a single day. That really restricts your position size. But futures firms, that's a whole different world. A 150K account might come with a total drawdown buffer of, say, $4,500. This larger buffer, relative to the contract size, is what lets traders really scale up their positions. It is the engine behind those million-dollar payouts you see people posting online. So let's just wrap this all up. The crucial takeaway is that account rotation isn't just some little trick, it's a complete system. It distributes your risk, it massively reduces emotional pressure, it smooths out your equity curve, it creates opportunities for payouts even when you're just treading water, and it makes sure you always have capital ready to deploy. So, at the end of the day, this strategy really asks a fundamental question about how you see yourself. Success in this funded trading space doesn't just come from being able to predict the market, it comes from implementing structure, system, and professional level risk management.